Ladies and gentlemen, if you thought gold at $4,000 and silver at $75 was impressive, you ain't seen anything yet. What we are witnessing right now isn't just another market rally. This is the beginning of a global precious metal supercycle. And today I'm going to show you why the numbers we're going to talk about, $8,500 for gold and $500 for silver, are not fantasy. They are statistical outcomes. If the macro trends play out the way real institutional money is positioning right now, what most people don't realize is that major market moves don't start with headlines. They start quietly deep inside the global financial system where stress builds long before price reacts. Right now, we are sitting in one of those rare moments in history where multiple macroeconomic forces are converging at the same time. This is not a normal cycle. This is not a short-term trade. This is a structural shift in how capital is protecting itself, and precious metals are right at the center of it. For years, governments around the world have relied on aggressive monetary policy to stabilize growth, lower interest rates, quantitative easing, expanding balance sheets, and record levels of debt. That approach worked until it didn't. The cost of that strategy is now being felt through persistent inflation, weakening purchasing power, and declining confidence in fiat currencies. When currency confidence erodes, capital doesn't disappear, it migrates. Historically, it migrates into hard assets, and gold is always the first beneficiary. What makes this cycle different is scale. Central banks are buying gold at levels never seen before in modern financial history. This isn't speculative money. This isn't retail emotion. This is institutional and sovereign capital reposition for long-term risk protection. When central banks shift behavior, they are not trading weeks or months. They are planning decades ahead. That alone should tell you something important about where we are in the cycle. At the same time, geopolitical fragmentation is accelerating. Trade systems are being restructured, supply chains are being regionalized, and nations are actively reducing dependence on reserve currencies. This creates friction, inefficiency, and instability, all of which increase the demand for neutral, universally accepted stores of value. Gold does not rely on trust, policy promises, or political alignment. It simply exists, and in times of uncertainty, that simplicity becomes incredibly valuable. Silver adds another layer to this equation. Unlike gold, silvers are both a monetary metal and a critical industrial resource. Demand is rising rapidly due to energy infrastructure, solar technology, electronics, and electrification. But supply is not responding at the same pace. New mining projects take years to come online. Grades are declining and production costs are rising. That imbalance doesn't resolve itself smoothly. It resolves through price. When industrial demand meets monetary demand simultaneously, silver historically moves much faster and much more aggressively than gold. Now combine all of that with the debt reality. Global debt levels are so extreme that traditional solutions no longer work without consequences. Higher interest rates strain governments, corporations, and consumers. Lower rates weaken currencies and fuel inflation. There is no clean exit. In environments like this, financial systems naturally gravitate toward asset reflation, allowing hard assets to rise in value as currencies absorb the pressure. This is one of the core mechanics behind long-term commodity supercycles. Another key factor is investor positioning. For years, precious metals were ignored, underweighted, and dismissed as dead money. That's exactly how major cycles begin. The early stages are driven by smart capital, quietly accumulating while sentiment remains skeptical. As prices rise and trends become undeniable, broader participation follows. That transition from disbelief to acceptance is where the most powerful price expansions occur. What we are seeing now is the transition phase. Gold breaking long-term resistance levels is not random. It is confirmation. It signals that capital flows have shifted from defensive interest into committed positioning. Once that happens, pullbacks become shallow, momentum builds, and volatility expands upward. This is classic supercycle behavior. And here's the critical point. Supercycles don't move in straight lines, but they do move far beyond what seems reasonable. When monetary confidence weakens, when supply constraints tighten, and when institutional capital aligns with long-term protection strategies, price targets that once sounded extreme suddenly become logical outcomes. Not overnight, but over time as the cycle matures. This is why understanding the macro drivers matters more than watching daily price fluctuations. When the foundation is built on structural debt, currency debasement, geopolitical risk, and supply scarcity, the trend has durability. These forces don't reverse quickly. They persist, compound, and eventually accelerate. We're not talking about fear. We are talking about math, incentives, and history repeating itself under modern conditions. Every major precious metal supercycle began with the same ingredients: excessive debt, currency stress, institutional accumulation, and global uncertainty. Every single one. The only difference today is magnitude. The system is larger, the leverage is higher, and the consequences are amplified. This is why the long-term outlook for precious metals isn't speculation. It's strategic positioning. Those who understand the cycle early don't chase headlines later. They recognize that when capital starts preparing for instability, it doesn't ask for permission. It moves first and explains itself afterward. When markets transition from long periods of consolidation into expansion, the price action always tells the story before the news does. Right now, gold and silver are doing exactly that. What we are seeing on the charts is not random volatility or short-term speculation. It is sustained momentum confirmed by structure, volume, and long-term trend alignment. This is how major moves begin, and more importantly, this is how they continue. Gold spent years building a massive base during that time. Every rally was questioned. Every breakout was doubted, and sentiment remained lukewarm at best. That kind of behavior is healthy. Strong markets are built on disbelief, not excitement. When price repeatedly tests resistance and refuses to break down, it signals accumulation. Eventually, that pressure releases, and when it does, the breakout is decisive. That's exactly what has happened. Gold didn't just drift above previous highs, it pushed through them with authority and followed through, which is a critical distinction. How once a market establishes new all-time highs, the psychology changes completely. There is no overhead resistance. There are no trapped sellers waiting to exit. Price discovery takes over. In that environment, momentum becomes self-reinforced. Funds that rely on trend-following models are forced to enter. Asset managers who are underexposed must rebalance. Even conservative capital begins to participate because the risk of missing the move becomes greater than the risk of entry. That's when trends expand far beyond what most expect. Silver, meanwhile, is displaying classic late base breakout behavior. Historically, silver lags gold in the early phase of major bull cycles, then accelerates sharply once momentum is confirmed. That lag is not weakness, it's compression. When silver clears long-term resistance levels after years of sideways movement, the release of stored energy can be explosive. We've already seen signs of that with sharp percentage gains occurring in relatively short time frames. One of the most important signals right now is the consistency of higher highs and higher lows across multiple time frames. This is not a short-term spike. Weekly and monthly charts are aligning, which tells us this move has depth. When momentum persists across those time frames, corrections tend to be shallow and brief. That's not the behavior of a topping market. That's the behavior of a market in the early to mid stages of expansion. Volume also plays a critical role here. Breakouts without volume are suspect. Breakouts with expanding volume signal conviction. We are seeing participation increase as price advances, which confirms that new capital is entering rather than existing holders simply rotating positions. That distinction matters because it means the trend is being fueled by fresh demand, not just reallocation. Another powerful indicator is relative strength. Gold and silver are outperforming many traditional asset classes during periods of market stress, and they are holding gains even when broader markets attempt to stabilize. That resilience is important. It shows that capital is not using precious metals as a temporary hedge, it's treating them as core holdings. When that happens, volatility shifts upward rather than downward. Momentum also feeds on expectations. As price advances, forecasts adjust. Targets that once seemed unrealistic begin to enter mainstream analysis. That doesn't end a trend, it usually extends it. Markets rarely peak when confidence is rebuilding. They peak when optimism becomes extreme and participation becomes universal. We are nowhere near that stage. Skepticism is still widespread, which tells you this move has room to run. The gold to silver ratio adds another layer of confirmation. When that ratio starts to compress after extended highs, it signals silver catching up. And historically, that phase coincides with some of the strongest price expansions in the entire cycle. We are beginning to see that transition take shape. If it continues, silver's percentage gains could significantly outpace gold as they have in past cycles. What's important to understand is that momentum markets don't offer comfort. They don't wait for consensus. They don't move in clean, predictable steps. They surge, pause briefly, then surge again. Investors waiting for perfect entries often end up watching from the sidelines as price keeps advancing. That's not emotion, that's pattern recognition based on decades of market behavior. Right now, the technical structure supports continuation, not exhaustion. Trend channels remain intact, pullbacks are being bought, breakout levels are holding as support. These are all signs of a healthy, developing trend. Until those characteristics change, not temporarily, but structurally, the path of least resistance remains higher. This is how major cycles unfold. First comes disbelief, then acceptance, and eventually enthusiasm. Price action tells us we are moving from disbelief into acceptance. And historically, that phase is where some of the most significant gains are made quietly, steadily, and often before the crowd fully understands what's happening. When people hear extreme price projections, the first reaction is usually disbelief. Numbers sound too large, too aggressive, too far removed from today's reality. But markets don't move based on comfort. They move based on the end. In every major supercycle throughout history, price ultimately travels to levels that seemed impossible at the beginning of the move. That's not speculation. That's how exponential trends work when the underlying drivers remain unresolved. It's important to understand that price targets like very high gold and silver levels are not short-term predictions. They're scenario outcomes. They reflect what happens when a system remains under stress for an extended period of time and capital continues to seek protection. In those environments, markets don't stop at fair value. They overshoot dramatically. That overshoot is not irrational. It's the release of years, sometimes decades of gold has always functioned as a monetary pressure valve. When confidence in currency systems erodes as slowly, gold rises steadily. When confidence erodes as rapidly, gold accelerates. If you examine previous cycles, whether in the 1970s, earlier 2000s, or earlier monetary resets, gold didn't peak because the economy improved. It peaked because price finally reached a level that restored confidence. Until that happens, the trend persists. Now, layer in the current scale of the global system. Debt levels today dwarf anything seen in previous cycles. Currency creation is larger, faster, and more coordinated. That means the magnitude of the adjustment required is also larger. When analysts anchor price expectations to past nominal levels without adjusting for system size, they dramatically underestimate how far price can travel. This is one of the most common mistakes in market forecasting. Silver amplifies this effect. Historically, silver does not lead quietly. It lags, compresses, and then moves violently. When monetary demand and industrial demand collide, silver doesn't trend smoothly. It spikes. Those spikes are not linear. They are vertical repricings driven by scarcity and urgency. Once silver enters that phase, percentage gains can far exceed those of gold in a very short period of time. Another factor most people overlook is revaluation versus appreciation. In a supercycle, assets aren't just rising in price, they are being revalued relative to currency. That distinction matters. If the purchasing power of money declines, assets don't need new buyers to move higher. They simply adjust to reflect the new baseline. In those scenarios, price targets that once seemed extreme become necessary just to maintain equilibrium. It's also critical to understand how institutional models behave. Large funds don't react emotionally. They respond to thresholds once certain price levels are reached and sustained. Capital allocation rules change. Exposure increases not because of belief, but because of mandate that creates a feedback loop. Higher prices force higher allocation, which in turn supports even higher prices. This is how trends extend far beyond early projection. Fear plays a role as well, but not in the way most expect. The final stages of major moves driven by panic selling. They are driven by panic buy, when investors realize that currency risk is structural rather than temporary. Now the urgency shifts. At that point, price becomes secondary to access. That's when markets experience the sharpest moves because supply cannot respond quickly enough to demand. Another key element is time. These price levels are not about days or weeks. They are about cycles measured in years. Super cycles unfold through phases, accumulation, confirmation, expansion, and finally excess. We are not in the excess phase. Excess is obvious. Excess is euphoric. Excess is when caution disappears. We are still seeing hesitation, debate, and skepticism, all signs that the move is incomplete. History shows that the most extreme price outcomes occur when multiple forces align simultaneously. Monetary stress, supply constraints, geopolitical uncertainty, and institutional participation. Remove any one of those and trends weaken. Right now, all of them are present. That doesn't guarantee a specific number, but it does support the possibility of outcomes that exceed conventional expectation. This is why dismissing large targets outright is dangerous. Markets don't care what sounds reasonable. They care about balance. When imbalances persist, price continues to adjust until stability returns. And in monetary-driven cycles, that adjustment often overshoots before it settles. The key takeaway is not fixation on a single number, it's understanding the mechanism. If the forces driving the cycle remain intact, price will continue moving higher than most are prepared for, and until then, extreme outcomes remain not only possible, but historically consistent with how supercycles conclude. That's how major revaluations unfold. Unquietly at first, and decisively and finally in a way that rewrites expectations entirely. Knowing a major cycle is underway is only half the equation. The other half is understanding what signals actually matter as the cycle evolves. Most investors get distracted by headlines, opinions, and short-term price swings, but super cycles don't end because of noise. They end because of structural change. Until that change shows up in the data, the trend remains intact, and the job is not to predict every move, but to observe what the market is confirming in real time. One of the most important indicators to monitor is the relationship between gold and silver. The ratio between the two reflects stress, liquidity, and risk appetite. When the ratio is elevated, it signals defensive positioning. Gold being favored as protection, when that ratio begins to compress, it tells us risk tolerance within the precious metals space is expanding and silver is starting to outperform. Historically, sustained compression in that ratio has coincided with the most aggressive phases of precious metals bull markets. It's not a time tool, it's a confirmation tool. Another critical signal comes from central bank behavior. Central banks don't chase price. They respond to long-term strategic risk. When they consistently add to gold reserves, regardless of short-term fluctuations, it tells you they are prioritizing stability over yield. This kind of behavior tends to persist through entire cycles, not just quarters. If that accumulation continues, it acts as a price floor and reduces downside volatility, allowing trends to extend rather than collapse. Monetary policy also plays a central role, but not in the simplistic way many assume. It's not about rate cuts alone, about direction and credibility. When policy tools lose effectiveness, markets begin to price assets independently of official guidance. That's when hard assets start to trend based on trust rather than policy. Watch how markets respond to announcements rather than the announcements themselves. If precious metals rise regardless of tightening or easing rhetoric, it signals policy is no longer the dominant force. Confidence is. Liquidity conditions are another piece of the puzzle. Expanding liquidity supports asset prices broadly, but in late cycle environments, capital becomes selective. When liquidity increases and precious metals outperform risk assets, it suggests skid trade is seeking protection, not speculation. That distinction matters. It separates temporary hedging from long-term positioning. Price structure itself remains one of the most honest indicators available. Strong trends defend key support levels. Breakouts hold, pullbacks fail to gain momentum. When those characteristics persist, it tells us the market is absorbing selling pressure with ease. Trends don't end quietly, they fracture, support breaks, rallies fail, and volatility shifts downward. Until those signals appear consistently, trend exhaustion remains a future concern, not a present one. Another overlooked factor is participation. During early and mid-cycle phases, participation is narrow. Only certain groups engage. As cycles mature, participation broadens. More funds, more strategies, more capital flows. Watching ETF inflows, futures positioning, and volume expansion provides insight into where the market is in its life cycle. Broad participation doesn't end a trend immediately, but it does mark progression. We are seeing expansion, not saturation. Sentiment should also be viewed objectively. Markets don't peak when fear exists. They peak when caution disappears. Right now, skepticism remains. Many still view precious metals as insurance rather than opportunity. That mindset is typical of developing trends. Excessive optimism, uniform narratives, and widespread complacency are not dominant yet. Until they are, the cycle has room to mature. Perhaps the most important signal of all is whether the original drivers of the move remain unresolved. Has global debt meaningfully declined? Has currency confidence been restored? Have supply constraints eased? Have geopolitical risks stabilized? If the answer to those questions remains no, then the foundation of the trend is still intact. Trends rarely reverse while their catalysts remain active. What this all comes down to is discipline. Supercycles reward patience and punish impatience. They unfold evenly, often frustrating both bulls and bears along the way. The role of the investor is not to react emotionally, but to stay aligned with the dominant structure until evidence suggests otherwise. Watching the right signals keeps you grounded when price accelerates and focused when volatility increases. It prevents overconfidence near highs and panic during pullbacks. It replaces guesswork with observation. That's how professionals navigate long-term cycles, not by predicting the future, but by recognizing when the present remains unchanged. As long as these signals continue to confirm strength rather than weakness, the broader trend in precious metals remains a process, not a conclusion. Folks, this isn't a drill. This isn't fear-mongering. This is data cycles and math. And when real money starts to move into precious metals in a structural way, the consequences are enormous. Not just for prices, but for people who positioned early. So if you own gold, if you own silver, don't just watch this market, understand it, because the greatest market cycle for precious metals in generations may still be right in front of us. And when it hits, the headlines will look tame compared to what the market's actually